In this video, I want to run you through how to time the property market. Instead of you waiting 5 to 10 years to get your capital growth, if you know how to time the market, you'll then know where to buy at specific times in the market. That'll speed your capital growth. And you could make 10, 20, even 30% in the next 12 to 24 months. Before I jump into that, I want to quickly explain the 4 pillars when trying to find a hotspot. The first is the ripple effect. So you go with the inner city, and then as the prices grow, they get pushed out. So, you got your inner city of the CBD. If we use Brisbane as an example, you had a 3-bedroom, 1-bath there now. It's about 1.3 million. So people are going further and further out with that 1.3 million so they can get a better house. Second thing is actually big events. So you've got the Commonwealth Games, you've got the Olympics and other major events which can further drive capital growth. The second thing is infrastructure spending. So when a government turns around and wants to spend a ton of money in a certain area, it creates a lot of jobs, which means they need to bring people in, people then relocate there, and that drives that demand component. At the moment, we're seeing a really massive shortage in supply, and then that goes into the 4th pillar, which is timing the market. The way that I time the market is I use a property cycle, which has been used for the last hundreds of years. It's called the 18.6 year land cycle. So essentially what happens at the first phase of the cycle, the major capital cities like Melbourne and Sydney have their growth. And then over time, they get far too expensive, and then the market spreads out to the smaller capital cities and regional towns. So at the moment, we're heading towards that second expansion phase where the smaller regional cities and the smaller capital cities are going to see the most growth over the next 4 to 6 years. I'm going to jump on the computer and I'm going to run you through what it actually looks like, and we can have a look at what's going on in the news, which is really showing that we're having this growth, and the growth is starting right now. So this is essentially the land cycle investor. So a lot of economists actually base their theory all around land cycles, and they believe that eventually, as these land cycles go through, there becomes a point where it's too expensive to create more land or build new homes, and then that creates a massive strain on supply, but the demand still grows, and essentially the demand overtakes the supply, and then that's when we have this second sort of expansion. So if you get a chance, just Google, land cycle investors or land cycle, and grasp your head around it. I found this really good graph to just to illustrate what it looks like. So essentially, what we had was back in 2019, it slowed down, and then it dropped off between 2019 to 2020, and then that's when we had that COVID. But that's where we had our first growth phase. And then this was about July last year, between July and December, where we have a mid-cycle slowdown. So you can see there's a bit of it kind of goes and then it slows down a bit. So a lot of the guys that I follow, like Bill Anderson, they were already, you can actually go back and you can see the interviews where they're talking in July saying that, hey, look, it's going to slow down between now and December. It's a good time to buy. And they were really spot on. So essentially what happened was after December, it just skyrocketed. But between July and December, it really was just sort of just going sideways. There wasn't that much growth, but there wasn't any, the prices weren't actually going down at the same time. So we're in the second phase right here. And this is when we're going to see more of a speculative boom. So we will see people doubling down. We'll see developers going in and building more high rises and developers going there building more homes, and people essentially get very, very speculative in this phase because they made a bit of money up here, and then now they're doubling down in this second phase. And this is the phase where, you know, your major capital cities don't have as much growth as your smaller capital cities. When we hit this end of the cycle, and there's this winner's curse between 2026 to 2030, that's where you got to be careful and make sure you don't over leverage yourself, because that's where they say the winner's curse is, and the market will you know, that's where it can drop at any moment. But between now and 2026, there's a lot of commentary around, you know, a lot of growth between now and then. And that's, you know, as a property investor, it's a good time to jump in. But, you know, when you do jump in, you want to look at your location. So maybe focusing more on, you know, your Perth, your Brisbane, your Adelaide, and staying away from your Melbourne, Sydney and Canberra, which are now, they get a lot of the benefit from the start of the phase. So, you know, once this cycle finishes, then you want to go towards Sydney and Melbourne, and they have the first boom. Gets too expensive there, then it goes over to the second and the smaller capital cities, and we get the second phase. So that's timing the market. So once you know how to time it, you then say, okay, maybe I'm not going to buy in Sydney, Melbourne. I'm going to consider Brisbane, Perth, or Adelaide, or more regional towns, and I'm going to go through how you can use software to identify these hotspots in these areas. But this is just a great illustration to show, you know, hey, right now is a good time to be buying. I know there was all the stuff around the mortgage cliff, but if you go out there and you actually do your research, I think I was reading on the most recent Commonwealth statement where they already said that two-thirds of the clients that were on that mortgage cliff they've already refinanced. There's only really 1/3 left that are still on that cliff. But, you know, this is what I'm trying to say to people. There's so many people that want to buy properties, and supply levels are, you know, 50% as a bare minimum less. I'm seeing in some suburbs there is 80% less listings than what there was compared to 2 years ago. So what we're now seeing is the bounce back and the second expansion phase. So we're seeing new headlines, and, you know, I don't really like using these as indicators on why the property market's growing, but this is just really playing out on how the cycle's going to work. So, you know, we're seeing houses bounce right back. I've already seen property prices start to already increase. A lot of clients I brought in January, I've already seen 10% minimum growth in the space of 3 months, but there's still so much more room in the pipeline. You know, rising costs hit pipeline for cheaper apartments. So, you know, they're just talking about the supply of new dwellings is getting like tightened up. Not many people want to build new dwellings because the profit margins aren't there. It's not viable commercially, and also, you know, creating new plots of land, it's just getting to that stage where it's not viable to go and develop that big piece of land because, you know, the profit margin is just not there. So in like some of the suburbs that I'm buying in, to get a house and land package, it will cost you upwards of $700K, but we're going in there and we're buying houses that are only 5 years old for $150,000 less, for $550K. You know, that's what's really stopping that supply. And all of that supply normally is new investment stock, which creates more rentals. But because there's no more new stock coming through, or no more house and land packages or investment apartments, it's then creating a big strain on the rental market, which is then pushing rents up, which is then pushing property prices up. So all of this sort of goes together and comes together as a one big ball for capital growth. Like even in Sydney and Melbourne, where in timing of the market, it should really be, you know, not getting that much growth. We've seen, you know, 30% growth in Sydney, and we've had 3 consecutive quarters of growth. So it's just showing that we're heading in the right direction for growth. Major areas where I'm seeing a lot of people buying in is mainly Brisbane, Perth, and Adelaide. But Adelaide is probably a little bit on the sidelines. It is coming up quite a bit actually, but go through, do your research. I want to start creating some videos on how to find hotspots moving forward, and also if you go back and check out some videos around how I find off-market deals, that'll help you. Once you've found that hotspot, go in there and actually get yourself a bargain, buy something below market value. So then if you buy below market value, that can just set you up to then buy your next asset a lot sooner. Rather than waiting 5 to 10 years, you can get it done in the next 2 to 3 years and build your asset base a lot quicker. So then you can then eventually just hold all of those assets and then eventually sell them off. But I'm going to go through how to build a portfolio in another video. If you did find some value of this, or hopefully these concepts did sink in, so it motivates you to actually make the move and start doing your research on buying your next investment property. Please like and subscribe this channel, and if you want, jump on my page, and there's a bunch of videos around how to negotiate on properties, find hotspots, and everything in between.